Hey guys, welcome back. Today, the complete Tesla trading playbook, the chart, the setups that fit it, and the levels that matter right now. Here is the last 4 months of Tesla on one chart, and it tells you exactly what kind of animal you are trading. From the February top, the stock bleeds for 6 weeks, and the bleed ends in a panic. Two bottoms at 337, printed 2 days apart, 1 cent apart. Then in April, the trend flips back up, and the same stock that everyone hated rallies a third in 5 weeks, up to the May high. Then June takes most of that back in 2 weeks. And look where the selling stopped, this teal shelf. Remember that band? Because the entire plan at the end of this video is built on it. Price is sitting on it as we speak. This video gives you the full playbook for a beast like this, how to read it, the 3 setups that actually pay on it, the 1 trap that wrecks accounts, and the exact plan for this week. Let's start with the numbers. Before you trade any stock, know the animal. Tesla is worth about $1.45 trillion, and it is the most famous, most argued about ticker on Earth. In the last year alone, it rallied more than 70% to a record, then crashed a third, then recovered most of it. And that is a normal year here. Now the numbers that change how you trade it. This stock moves about 4% in a normal day, 4 times what the index does, so size every position smaller than feels right. Liquidity is never your problem. About $30 billion of Tesla changes hands every single day. But here is the number most people miss almost half of all mornings. Tesla opens a full percent or more away from where it closed. It gaps. A stop loss does not protect you from a gap. It just sells you at the open. And earnings hit 4 times a year. The next one lands July 29th, and every level in this video resets that night. What actually moves it? Robotaxi and self-driving headlines, delivery numbers and margins, and one man's posts. You know the man, know the animal. Now let's read its chart. Reading any stock starts the same way, zoom all the way out. This is a full year of Tesla, 1 candle per week, and it is nothing like a calm uptrend. From a summer base near 289, the stock climbs all the way into December and peaks at the record, 499. Then it gives a third of that back by April. Then it recovers a chunk. Then June knocks it down again. That is not an escalator. That is a pendulum. But now look at the floors. The November shakeout stopped near 383. The April panic stopped at 337. And this month's flush was caught at 380, a higher floor than April. Sellers swing this stock around, but buyers defend their levels violently every single time. So the tide rule for Tesla, the weekly, is a giant range. You trade levels, not trends. Buy at proven floors with confirmation, take profit into the ceilings, and never chase the middle. Now zoom into the daily. Now the daily chart, where the decisions happen. And check the dates along the bottom, February through today. Box 1, you already have the weekly says range, so levels rule everything. Box 2, structure, who is in control. From the February high, every bounce tops out lower, and every drop takes out the floor below it. That staircase is seller control, and it grinds all the way down into that double bottom in April. Then one candle changes everything. Price closes back above the last lower high, and from that one close, the staircase is broken. Structure flipped. Box 3, volume, the bars filling in along the bottom right now. And here is the twist most people miss on Tesla. The loudest day of the year was not a selling day. 114 million shares. And it was the flip itself. Buyers made the loudest statement on this chart. The March breakdown was heavy, the April earnings gap was heavy, but neither came close. Box 4, the white line crossing the chart is the S&P 500 on the same scale. And this is where Tesla humbles you. Since February, the market is up and Tesla is down. It spends the spring chasing that line, almost catches the market line in May, within 0.5%, and then falls right back behind. This is a laggard right now. You trade laggards at your levels. You never chase their rallies. 4 boxes read, 1 to go, and on this stock, the levels decide everything. Box 5. The levels. Forget every squiggle on this chart except 3 prices. Check the dates. This is just the last 7 weeks. Price number 1, overhead the seller band, this red zone roughly 445 to 453. Twice the May rally drove into it, and twice the sellers threw it back down. Until that changes, rallies die there. Price number 2, the trigger. 418.5, the June bounce high. As long as Tesla lives below that gold line, the June downswing is in charge. The day it closes back above, the downswing is broken. And price number 3, right underneath us, the buyer shelf, roughly 380 to 389. 4 times in the last week selling slammed into that teal floor, and 4 times it stopped dead in this band. And today printed a monster bounce straight off the shelf. The seller band above, the trigger in the middle, the buyer shelf below, 3 prices, 1 battlefield. Price is parked just above the shelf as we speak. Time to meet the 3 traders who run this playbook. Three traders are going to run this exact stock through the last 7 months, each starting with $10,000. First, this is Mike. He trades only the 3 setups in this playbook, stop and target written down before he clicks buy. Next, this is Jake. He calls bottoms, he buys spikes, he sizes up when he is sure, and he is always sure. And finally, this is Tom. He waits for proof. By the time a move convinces him, the discount is gone. Same stock, same starting money. Watch what the entry alone does. Setup number 1, the breakout retest. This is November into December, and it starts with a crash. Tesla loses almost a fifth of its value in 2 weeks, and Jake has seen enough, down 15%, bargain. He buys the panic day at the close, heavy no stop. The next morning the stock gaps 4% against him, straight into the panic low. A week of dead chop later he dumps it near the low, $300 poorer. And that was nearly the exact bottom, by the way. Being early with no plan is just being wrong. Now the real signal. The stock stops falling and builds a base, day after day pressing against one ceiling near 437. Then in early December a giant green candle smashes through it. That is the breakout, and Mike does not chase it. Breakouts punish chasers. Instead he places a resting order at the old ceiling because broken ceilings get retested, and when the retest holds, the ceiling has become a floor. 5 days later the dip comes, price comes back to kiss the exact ceiling it just broke, and his order fills without him touching a button. His stop goes under the last dip of the base. His target twice his risk, up near 468. 1 week later the rally rips through the target, $1,000 on 500 risk. And only then does Tom finally believe. He buys 12% above Mike's entry after 3 giant green days, and the very next red morning shakes him straight out, minus 200. 5 days after the target, Tesla pushes on to its record high, $499, with Mike already paid. The retest is the trade. The breakout is just the advertisement. One setup in, and the scoreboard already tells the story. The retest paid Mike a clean 1,000. The bottom call cost Jake 300, and the December rally he missed while licking that won't cost him far more. Tom paid 200 for arriving last. Setup number 2, the trend flip. February to May, the full round trip from the gist, and the cleanest lesson in this whole playbook. Start at the February high up here, 436. From that peak the stock walks down a staircase, every bounce tops out lower, and price takes out floor after floor. That is seller control, and the rule is simple: as long as price levels below that line, the last lower high, every dip is a trap. By late March, down a quarter from the record, Jake is certain the bottom is in. He buys heavy at 362, on margin this time, still no stop. The staircase keeps walking one more lower high, then the elevator. In early April Tesla craters to the first bottom at 337, and Jake sells everything into it. His worst fill of the year. 2 days later the market retests that low and misses it by 1 cent. 337.24, 337.25. A double bottom to the penny printed without him. But a bottom is not a signal. The signal comes a week later, one enormous green candle. The loudest volume day of the year, you saw it earlier. Closes decisively above the last lower high, the staircase is broken. Structure flipped. Mike buys that close at 392. His stop goes under the flip candle near 362. His target the same February high where the slide began. The next big green day finally convinces Tom, 2% above Mike's entry. Then the earnings gap. A strong quarter, sold off anyway on one spending headline, opens 3% lower and Tom is gone, minus 200. That same selling wave drags price to the shakeout low 364. $2 above the stop. The level holds, because the stop lives under the candle that proved the buyers, not under some round number. From there the new trend does the work, and in mid-May price hits the target at the February high. $740 for Mike on 500 risk. The flip is the trade, the bottom is just the bait. 2 setups in, and the gap is widening. Mike's flip trade banked another 740. Jake's margin bottom call cost him $12.50. Twice now he has sold into the panic itself, and Tom keeps donating 200 at a time for arriving late. Setup number 3, the institutional zone, and this one comes with a bonus signal. It is mid-April, the trend just flipped, and one ceiling all month caps every rally near 409. Then watch the sequence. The pullback into early May leaves one last red candle, and 2 sessions later, a huge green leg bursts through the ceiling without a fight. Force like that is not retail money. Someone enormous absorbed all that selling. That candle is the zone, the last red candle before the breakout, roughly 389 to 402. Mike marks its range, parks a resting buy order at the top of it, and goes back to waiting. The leg runs without him, all the way to 453, and he does not care. His price is his price. A week into the run the first dip arrives, and it is close enough for Jake. He buys it with no level underneath. The dip keeps dipping. On Monday it stops $3 short of the zone. Almost touching the zone is not touching the zone. Mike's order stays put. The next day price finally touches the zone and fills him at the top of the band, while Jake, 6% underwater, sells his dip in disgust at the very prices the institutions are defending. One trader had a level, one had a feeling. His stop sits 1% below the zone, his target twice the risk. And here is the bonus: the gold line drawing across the chart is the actual 20-day average, rising all month, and it crosses right through the zone that same week. The institutional footprint in the trend zone rail, pointing at one price. Two reasons, one price. The odds stack. The zone holds. The next green day Tom buys the reclaim at full price, rides it for 2 days and pockets $70 at the first wobble. 5 sessions after the touch, Tesla rips through the target. 1,000 for Mike, on the same dip that cost Jake $650. After the zone trade, the scoreboard is brutal. Mike is up 27% on 3 clicks and a lot of patience. Jake is down 22, every loss the same shape, right direction, no level, no stop. Tom is still grinding out crumbs, 1 chapter left, and it is the expensive one. And now the trap, the one habit that empties more Tesla accounts than anything else, chasing the euphoric run. It is late December. The stock has gone a month nearly straight up, 30% from the November low, and the headlines are everywhere: robotaxis, records, the future arriving early, the actual car deliveries shrinking. Price is sitting at the record on a promise, and Jake cannot stand it anymore. Everyone on his feed is rich. Right before Christmas he goes all in at the record close, 489, on margin. No stop, it is Tesla, what could go wrong? Mike runs his checklist instead. Is this a flip? No, the trend flipped long ago. He would be the last buyer, not the first. Is this a zone return? No, price is at a record, and above a record there is no level, which means no defined risk. Is this a retest? Nothing was broken. 3 questions, 3 no's. No setup, no trade. He sits on his hands. And even Tom stays out, not from discipline. He simply cannot click first. For once, slowness finally pays. What follows is worse than a crash, a leak. The last week of December drips 8%. No scandal, no disaster. The stock just stops going up. Then late January hands him a bounce halfway back to even, and that bounce is the cruelest part of every trap, because it turns a bad trade into a long one. He holds. The rollover comes anyway. In early February the floor goes and Jake, down 20%, waves the white flag and sells everything into the flush at $390, $2,400. His worst trade of the whole 7 months. On the best headlines of the year. For Mike, skipping it cost him nothing. And watch where his panic lands, inside the same teal shelf that sits under price right now. Euphoria tops out at records. Panic bottoms out at the shelf. The chart never changed, only the crowd did. If you missed the run, you missed it. The pendulum always swings back to your levels. So here's the payoff. The exact map as of tonight. Nothing on this chart is hidden, and every level comes from candles you have already seen. Price closed at $399. Standing just above the shelf, the 380 to 389 floor that caught 4 panics in the last week and bounced hard today. That band below us is the line in the sand. Far above, the seller band where rallies died twice in May, 445 to 453, that is where the sellers live. And between them, one line 418.5, the June swing high. That is the trigger. Plan A is the reclaim. If Tesla prints a daily close above 418.5, the June downswing is broken and buyers are back in charge. Entry on that close. Stop under 408, just beneath the early June bounce. If the reclaim is real, that old ceiling holds as the new floor. First target where the sellers live, 445. Better than 2 to 1. A base hit, and you take it. Plan B is the exit signal. If a daily close lands below the shelf, below 380, the floor that held November, February, and June is gone and the pendulum swings lower. That is not a shorting invitation. It is a stand aside and wait signal, no longs until a new base builds and structure flips again, exactly like April. And right now, neither has happened yet. Price sits between the shelf and the trigger, so the playbook says the hardest thing in trading: nothing. These are scenarios, not predictions. We react to closes. The market goes first, then we act. And remember, earnings on July 29th resets this entire map. One more thing before you go. The 4 rules that make this stock tradable. Here is the whole 7 months on one screen. Mike finished up 27%, the retest paid him first, the flip came next, and the zone paid him the fastest. And the one setup he refused, the chase at the record, is the only red mark on this screen. Skipping it cost him nothing. Jake finished down almost half. And here is the uncomfortable part: he was never really wrong about direction. His bottom call in March was $25 early. His May dip buy was 1 level early. Nearly right every single time, with no level and no stop. That is the most expensive way to trade there is. And Tom, 7 months, 4 decisions, minus $330. He paid full price for every proof and got shaken out of every wobble. Same stock, Same screen. The entry was the edge, and the trade you refuse is half of it. Your whole Tesla playbook fits on one screen. Rule 1. Rid the tide. The weekly says range, not trend. Trade your levels and leave the middle alone. Rule 2. Map the three prices: the seller band overhead, the trigger in between, the shelf underneath. Price only means something at those. Rule 3. Wait for a real setup. Only 3 entries exist in this playbook: the retest of a broken ceiling, the close that flips structure, and the first return to an institutional zone. If it is not one of those 3, it is not a trade. And Rule 4. Never chase the spike. A record high on a loud promise is not a level. Miss the move, shrug, and let the pendulum swing back to your prices. Buy Tesla at your levels, or let it go without you. That is the complete Tesla playbook. How it swings, the 3 setups that fit it, the 1 trap that does not, and the exact map for this week. The levels expire earnings on July 29th redraws everything, so recheck the map before you act. And the obvious part, said plainly, this is education, not financial advice. This stock gaps through stops almost every other morning, so never risk money you cannot afford to lose. Next week, the Apple playbook. Subscribe so you don't miss it, and tell me in the comments which stock you want broken down after that. See you in the next one.